Broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Drewry's Dry Bulk Shipping Market Outlook webinar. My name is Antonia Mitsana and I'm Marketing Manager at Drewry, and I am joined today by Rahul Sharan, Director in our Bulk Research team, Deepanshi Puggalok, Research Analyst, and Santosh Gupta, Deputy Director in our Maritime Financial Research team. In today's session, Rahul and Deepanshi will give us a summary of our latest research on the dry bulk shipping market. We will share some of the key findings from our latest dry bulk forecaster report, and we will discuss the outlook for the market. Santosh will then cover carrier profitability and company financials. This presentation will take us about 20 minutes, and after that, we have allocated another 10 minutes to answer any questions you might have for us. You can ask a question at any point using the questions panel on your screen, and we will try and answer as many questions as we can after the end of the presentation. We will also be sending out a link to the recording of the session tomorrow. So let's begin with the content we have prepared for you. Next slide, please. So for those of you who are not already familiar with Drewry, we are a leading provider of research and advisory services to the maritime and shipping industry. We've been charting and analyzing the global shipping markets for more than 50 years, and we have offices worldwide in London, Delhi, Shanghai, and Singapore. Our research offering comprises of market reports and online services covering all the key shipping sectors, including the dry bulk forecaster report, which is the source material of our presentation today. We also offer investment research reports covering listed companies in the maritime space. Our maritime advisory team offers project-based advisory services to the shipping industry and to financial institutions on a wide range of topics, ranging from strategic planning, due diligence, feasibility studies, and more. And finally, our supply chains advisory team provides solutions to shippers and BCOs to help them benchmark their ocean freight costs and improve their ocean freight tender processes. So after this short introduction on Drewry and our research offerings, Rahul, Deepanshi, over to you to talk about dry bulk shipping.
Thank you, Antonia. Before we begin, hello everyone. And just for our subscribers, that those who are not our subscribers, they might not be knowing that we have now shifted to our digital platform, which we call Drewry On Demand. And all the subscribers already know it. We have given the demo. Those who are interested in a demonstration of this digital platform are more than welcome to shoot an email, and we will respond immediately with the demo. Today, we will talk on the fundamentals of the dry bulk market and some key developments, especially on the geopolitics and the new mine coming up in Guinea, and then some key forecast numbers. Before we begin, this is what actually shaped the dry bulk market in 2025, particularly the uncertainty that we'll talk about. As you can see, that this is an index which was developed by 3 economists, and you can see that this has skyrocketed in 2025. It increased more than even in the COVID era. So this has driven more or less the demand side of the market, and also to some extent the supply side, when we saw new orders plunging in because of the tussle between US and China. About what would shape the dry bulk market in 2026, Deepanshi, you want to share your views?
Yeah, sure. So among all the major commodities of the dry bulk trade, iron ore constitutes the most amount of trade, as we all can see. And iron ore trade is majorly driven by the Australia and Brazil. And as Rahul mentioned, that we will be talking about the new upcoming Simandou mine that has started its operation in this month. And the Simandou mine and the Canadian iron ore is the new leading, I would say, the exporters for the iron ore. If I talk about the coal front, it is majorly dependent on all the climatical goals that are set by the country. And on the grain front, US has reached its major exports this year, and its corn exports have been on the record high because of the delay in the Russian corn, and also less competition from the Ukrainian corn. Whereas if I see US in the minor bulk commodities, particularly for the soybean, the trade has been like zero for the past 4 or 5 months before they have finally come up to an I would say, the trade deal that the China will again start the importing US soybean. So that's about the overview of all the demand drivers. We'll delve more into the iron ore and the soybean part later in our presentation. So over to you, Rahul.
Yes, looking at the fundamentals of the market, 2025, a little bit on that. The fundamentals were really good in 2025, mainly from the demand side. But we saw the market, the charter rates plunging in 2025, mostly on the geopolitical issues that we have seen so far. Many black swan events coming up, and which resulted into the utilization of dry bulk fleet going down in 2025 compared to the previous year, which was 2024. But we expect this to increase in 2026, mostly because the demand side should show some strength, and the uncertainty, as you saw in the previous chart, it has already started going down, and there's clarity on many on the trade front. So we believe that the demand side is going to be stronger next year. Talking about the supply side will be a little bit tight, mostly because the new orders were very low in 2025, which will mean that in 2026 and 2027, the deliveries will be low. The order book is pretty low, almost 10% of the dry bulk fleet. So this means you just compare it to what happened in 2013-14, when the order book was more than 60% of the fleet. Today, it has come down to 10%. So that is the kind of crunch in supply that we might see going ahead in 2026 and 27. Also, just one emphasis on what we see would be a major driver for the dry bulk demand in 2026, and also in the period beyond that. So we believe that with the green push, with the tightening norms on the carbon emission, the EV batteries, there will be increase in sales of EV batteries, EV vehicles, and also the power has been switching swiftly towards more cleaner sources. So this will mean that the imports of manganese ore, nickel ore, or lithium ore, they will increase to support this drive. And as you can see, the share of minor bulk in total dry bulk might go up from 25-26% in 2020 to 30% by 2030, and mostly because of these issues that we just talked about. And now coming to the Simandou mine, which is very much in news of late. We had come out with an opinion piece, a very nicely written research article on this 5-6 years ago. We are coming out again next week. Deepanshi would like to talk about this. Deepanshi?
Yeah, sure. So as I talked about this earlier in the presentation, that Simandou has let out its first cargo shipped in November 2025. It was around 10,000 tons, and this came out from the Simfer mine, that is in the southern block of the Simandou mine. We'll talk about how it is structured. So if I talk about the geographical location of Guinea, it is right here. And if we see that Australia being the largest exporter of iron ore to the China, Guinea can be a newer player. And if I talk about how it is going to affect the dry bulk market, it will create a long haul trade route from replacing Australia, not completely replacing Australia, just a chunk of Australian iron ore from Guinea to China. And if I talk about Simandou, it is one of the largest newer supplier source that has come out in the recent time. It will be a very bullish for the Cape-size market, and it will also help China to reduce its reliance on Australia. And if I talk, as I was talking about, it came out from the southern part. It is structured as that the two blocks are in the northern half and the two blocks are in the southern half. And in the northern half, China's share is massive. It almost has almost more than 50% stake in the companies that are in the northern block. And apart from that, China influence is there in the infrastructure segment also. And if I talk about why does China want Simandou and why Simandou is very important for China, is because China takes up more than 70% of the global iron ore imports. And when we talk about what are the major partners for China, is Australia and Brazil. And if I talk about Brazil, Brazil is already having very long-term agreements with the Chinese companies or Chinese shipping companies. So if we talk about that, whether Brazil will be replaced with the Guinea iron ore, the question maybe not, because it already has so many agreements. And if I talk about Australia, the Australia-China relationships have been like haywire on the political front. There has been things that have been happening for the past 5-6 years. And with that, the China once also completely stopped taking coking coal from Australia. So, and even if you see that after that period, it has massively reduced its coking coal imports from Australia. And China, for the long time, has been looking to diversify its supply sources of iron ore. And with Guinea coming to operation, it might take almost all of the Guinea iron ore. And how it is going to impact the dry bulk market and the Cape-size vessel, we have done an assessment. And according to our assessment, we will have more of 116 vessels going to from China to Guinea to China route if the whole of 120 million tons of cargo get replaced from Australia. Because of its longer haul nature, it is almost 3 times the distance. So that's about the Guinea story.
Yeah, thank you, Deepanshi. And on the soybean front, that Deepanshi talked about when saying how these have taken place over past 5-6 months. As you can see that between May and September, there was almost no soybean trade between US and Australia and China. Although this is a lean period, soybean is a seasonal trade market, and between May and August, usually there is no shipment of soybean between these two countries, but it actually became zero shipments. And we came out with a story in our quarterly report saying that what will happen if it continues for long, particularly in September, October, November, which are the main which are the main season for soybean coming out from US. But as we all know that they have signed a deal, and this has cooled down a little bit, and there's a contract of importing soybean from US. So we believe that this is going to be back into operation. Sorry. This is mostly a Panamax market, and this will actually certainly be a shot in the arm for the Panamax segment. So all of them put together, with the iron ore being shipped more iron ore being shipped on Guinea and China, and soybean for Panamax being shipped on US and China. So we believe that the market going ahead should be a positive market from the charter point of view, and it should be a better market in 2026 particularly. And this was one of the key topics that we wanted to discuss when US came out with this USTR policy. I mean, this policy was in talks even before Mr. Trump came into office in US, but it gained momentum when he came earlier this year, and it was put on hold, again came into operation, but the impact had been different. Deepanshi, you want to discuss this?
Yeah, sure. So if we talk about this thing right now, it has completely lost momentum. The fee was proposed from the US side, then China retaliated when that fee was about to come into the effect, almost with the same kind of fee on the US vessels. And with an agreement this month, the both countries have decided to suspend it for the next 1 year. And if we see even before that, in the first quarter, we could see the impact of this USTR fee because of the how market sentiments were there in the first quarter. And we saw a massive dip in the Chinese built ordering and the second hand transaction. But it has been normal if we compare it to 2024 in the coming and the further quarters. So this is just in a story now, and we'll see how the things will shape in the next 1 year or after this will actually come into the effect. So moving on.
Coming to our final two slides, we will talk about the charter rate outlook and how we project rates to be in the forecast period. We at Drewry, we have normally the forecast on the quarterly basis. So we do a 6-quarter forecast and then a 5 years forecast on an yearly basis. So we forecast charter rates up to till 2030. And in every report, in every quarterly report, we try to compare the forecast numbers with the actual numbers. So for example, our rates at the beginning of third quarter 2025, we had a forecast for third quarter. And then at the end of third quarter, we compare it with what actually happened to our forecast and how close or distant we were and the reasons behind that. We try to look into reasons. We analyze those deviations, and we publish the entire analysis in our quarterly reports. So this particular chart has straight away come from our quarterly report, the forecaster, and where we showed the quarterly performance. In the next issue, which will be published in January, we will do an annual comparison that what we projected at the beginning of 2025 for rates to happen in 2025 and what actually happened. So we will do this comparison in January 2026. And this is our outlook for 2026. I will pause for a moment for you to have a close look, digest, and then I will explain why do we say what we are saying. So as you can see that all the vessel segments, Handy, Supra, Pana, and Cape sizes, all four, we project them to go up in 2026 compared to 2025. Now, the issue is that we do all our forecasts for demand as well as for supply under different scenarios. So we build scenarios, base case, low case, high case, and the assumptions behind those scenarios we publish very clearly. For example, we take the economic growth of the major economies, those which drive the dry bulk market, their economic performance as expected by the major economic houses, IMF and Oxford Economics, and then we build scenarios. What if this will not happen? What if the global economy or the major economies grow by a certain percentage, less than that or more than that? Similarly, we also try to analyze the impact of various regulatory authorities, various regulations coming into effect. For example, EU ETS. So the ETS will be fully operational, 100% applicable from 2026. This might have an impact on the speed of a ship because many owners might try to reduce carbon emission by reducing its fuel consumption, by reducing the speed. But that will depend on how the demand is. There are a lot of things which will come into play, and all of them we have tried to put into different scenarios. That if this happens, then rate will be this. Then this will be our race, our charter rate outlook. Under our base case scenario, which is most likely to happen according to us, we are projecting a higher charter rate in 2026. Similarly, even more higher charter rates in 2026 under the high case scenario. But if we see more geopolitical issues coming up in 2026, the major economic research houses, Oxford Economics and IMF, if they project the global economy to grow at a certain percentage and it actually doesn't perform that well, and the economy, especially the Chinese, US, European, Japanese, Korean, and the global economy grows at a slower rate, in those cases it might happen the rates actually contract. So we have clearly defined them in our different scenarios in the report. So this is what we have projections for different size of the ships in 2026. For a longer term outlook and on the quarterly basis, we have already published in the report which was published this month itself, at the beginning of this month. I will give now this to Santosh, so he will deliberate on from the financial research side. Santosh.
Thanks, Rahul. So before I talk of the dry bulk shipping equities, I'll talk a bit about our maritime financial research division. So next slide, please. So under our maritime financial research, we cover about 34 globally listed maritime stocks under fundamental equity research, and these stocks are listed over in the US and Europe. Now, broadly, maritime financial research has 3 verticals. I already talked about the investment research division. Under the financial advisory, we provide project assessments and industry sections for the equity offerings as well as the bond offerings. Then under valuations, we provide shipping valuations, company valuations, ports and terminal valuations. So with this, we'll move to the next slide. So this slide talks about the performance of Drewry dry bulk shipping equities. So taking it further from Rahul, when he started, he said about the uncertainties in 2025 and how the charter rates were impacted. So the equities performance had been a bit different from that, and we have seen the equities, dry bulk shipping equities index rising about 32.2% YTD compared to S&P 500, which is up 14.5%. And this comes against the dismal performance which we saw last year, where the equity index only increased 23.5%. Now, going into more granularities, if you look at the individual stocks, it's mainly Pacific Basin which is driving the index, and it's up 64%. Now, one region which has contributed to this is the Cavalier Group, which is a Hong Kong-based commodities and shipping group, which has taken a stake in Pacific Basin, and their stake went up from 7% to about 16 or 17% now. And the market has taken them buying their stake in Pacific Basin very positively, and as a result, their stock ran up. However, if we look at the other dry bulk shipping stocks, DS Norden is up 27% and Star Bulk is up 26%. So there are 2 factors which are driving these 2 stocks. The first is the fleet renewal and the capital gains which are coming out of it, and which is also helping their results to an extent. And other is, of course, the increase in charter rates which we have seen recently. Next slide, please. I'll not spend much time on this slide because this talks about 2025 results, where we saw the TC revenue declining significantly, and with that the revenues, the net profit also declined. So I think the TC revenues declined close to 23%, and this is our aggregate of the dry bulk shipping companies which we cover, and net income declined more than 60%. However, I will spend more time talking of the 3Q25 results which have just come or have started trickling in. Next slide, please. Just spending few seconds on this. So the extreme right chart is a bit important, where we can see that the charter rates have recently started going up, and I will talk how it relates to equities in coming slides. Yeah, next slide. Yeah. So as I mentioned, I want to spend some time talking of the 3Q25 results, and DS Norden was the first one to report. So DS Norden, both the TC revenues declined about 32.2%, and their EBITDA declined 6.3%. So the DS Norden is a company which operates owns and operates close to 400 vessels, and out of that, they only own 20 vessels. Other vessels are all charter-in vessels. So their EBITDA was supported by the capital gains that they received from the sale of vessels, and this sale of vessels also helped their net income. So the net income was in fact up 3.6%. If I go to the Star Bulk shipping result, and Star Bulk has more than 140 dry bulk carriers under its fleet, their TC revenue declined 21.3%, EBITDA declined 48.7%, and if I look purely at the TC rate, it declined about 12%. So we can see that this trend is across. So in 3Q25, the TC revenues are declining, and EBITDA is also declining. In some cases where the companies have sold their fleet at a gain, the net income has been supported by it. So, and we have also seen that the company's debt levels have declined if we compare 3Q24 and 3Q25. This is across both Star Bulk and DS Norden. Now I'll take some time to talk about 2026, what we expect of 2026. So in 2026, we expect the fleet renewal to continue, and with the expected higher charter rates, which Rahul and Deepanshi just explained, we expect the dry bulk tankers companies' revenues and net income both to positively benefit from that. I will take a moment to just talk of our coverage. So in next slide, please. So in dry bulk shipping, we have about 4 companies: Star Bulk, Pacific, DS Norden, and Diana Shipping. And then we have other sectors also, which is container shipping, LNG, LPG, and crude tanker, then product tanker, and ports and terminals. So with that, I will now hand it over to Antonia. Thank you.
Thank you, everyone, for this very informative presentation. We've had a few questions coming in already, but as a reminder, if you have a question for us, you can still add it in your questions panel on your screen. So Rahul, Deepanshi, I have a question for you. Do you think the cost of iron ore in China, including freight, mining, etc., will it be cheaper when shipped from Guinea compared to Australia?
Okay, so actually this needs a clear, a clear and more detailed dive down look into what is happening with the quality of iron ore as well. So as Deepanshi talked about that, the Guinean iron ore, which is almost 65, it contains 65% Fe content, which is of a very higher grade iron ore, whereas the Australian iron ore, which is on an average 62% with 62% Fe content, and with more and more exploration, and it's the Fe content is actually going down. It has come down to 60-61%. So this way, and even the cost of mining in Guinea, I presume would be lower than the cost of mining in Australia, particularly the labor costs and others. So in totality, when you compare the quality of iron ore plus the mining cost, that might be lower for Guinea, substantially lower when you compare it with the increase in freight cost. So overall, the landed cost of Fe, actually Fe content in China, we believe that the Guinean iron ore could be cheaper per Fe content. So in that way, yes, it should be cheaper. Maybe not now, but it should become cheaper as it operates at its full scale.
Understood.
Yes.
Thank you, Rahul. One more question for you. Do you see any impact on charter rates with the intensifying Russia-Ukraine war?
Okay, so this has been here for quite some time now. We have seen this, rates being affected when this crisis began. Especially the Black Sea was completely blacked out, and but as this passed and things have actually become easier now, and with every day we see sometimes it gets intensified, sometimes there are some ease in the tension, but it has continued. I guess that the charter rates have now become immune to particularly Russia-Ukraine war, and irrespective of the intensity of war between these two, I believe the charter rate will be driven by many other factors than actually Russia and China were now. Thank you.
Thank you, Rahul. I've got one more question for you. Looking at the earnings forecasts on all segments, the base and high case for 2026 are higher to a fair extent than 2025, and the bad case is significantly lower than 2025. Could you elaborate what are the drivers for the low case, please?
Okay, so as I mentioned that one of the low case was, under low case was the economies, the major economies, particularly those which matter to the dry bulk industry, Chinese economy, US and European economy, and also the Japanese economy, and then also the global economy overall. If they grow in 2026 at a lower growth rate than what is projected by big economic research houses like IMF and Oxford Economics, then that could be one of the reasons which might drive down charter rates in 2025, number one. But this is from the demand side. And one more factor could be, the intensifying of uncertainty. So if there are more issues coming up in 2026 which might affect the global trade, that could be a reason why the low case might happen in 2026, our low case forecast. But apart from that, a more impact would be from the supply side. So if the supply, we still have a lot of ships which are inactive at the moment. So compare that with pre-COVID era when the inactivity was less than 1% to now, which is 5, 6, 7%. So that quantity of ships have been inactive even now. If most of them join the operation, so that will be one of the key factors which might drive down the charter rates by increasing supply. If the speed of the ships actually do not come down and there is no impact of any regulatory, there is no impact of any regulation on ships on the sailing speed, so that could be a big factor where the speed goes actually up because of the demand. So that will be increasing supply from another quarter. So both of them put together, the demand side, the demand side downside, and the supply side increasing effective supply, all of them put together might result in the low case actually happening in 2026.
Just to mention, when we were comparing our first quarter forecast with the one which we forecasted and the actual, we were usually we are pretty close to our base case, like we also saw in the slides. But in the first quarter, we were actually pretty close to our low case because of all the uncertainties that started happening in this year.
Yes, so, especially in January and February.
Yes, so that is why we give the certain cases.
Yes.
So that's it.
Thank you, Deepanshi and Rahul. I think we've overrun slightly, but I will ask another question if I may. So China reduced imports of coking coal from Australia, which reduced demand for shipping. Where is China importing from now?
Okay, so this is actually a good question. So China, as Deepanshi mentioned, that China was trying to reduce its dependence on Australia. In that, the way it is investing heavily in Guinea for iron ore. Similarly, it was investing a lot in Mongolia for coking coal, and they were actually building many railway lines from inside Mongolia towards Chinese border, and that became operational during after that period when they had a big tussle in 2021-22. So it actually substantially increased its coking coal imports from Mongolia. Plus, Russia also came into picture, and they have also been exporting a lot of coking coal to China. So China has replaced Australia for coking coal with Russia and Mongolia.
Thank you, Rahul. One last question for Santosh. Which stock do you think we should consider investing in?
Yeah, thanks, Anthony. So, as we discussed previously, in 2026, we expect the capesize charter rates to do well. And in this scenario, I think I would like to go with a company which has significant exposure to the capesize market. So, Starbulk is a stock which is worth looking at. Thank you.
Yes, over to you, Antonia.
Thank you. Okay, we're now 5 minutes past our allocated time, so I suppose this brings us to the end of this session. Thank you everyone for joining us today. We will be sending out a link to the webinar recording tomorrow, so you can go back and listen in. And we look forward to seeing you again at another Drewry event. Thank you. Have a nice day.
Thank you.
Thank you.